So my name is Tanner Blackburn. I am the whole farm underwriter for NAU for the Southeast branch. So I'll be handling all of the underwriting for the Southeast for all the different agencies and everything. And then Clasey is with me. She's head of the entire eastern side of the country's whole farm underwriting. So yeah, I'll go ahead and get into it. Um, Whole farm protection, March 6th. Disclaimer, the purpose of this material is to promote awareness of risk management concepts and to highlight USDA's risk management products, features, benefits, and availability. This information is provided for training only. Any discrepancy between the training material and the policy is not intended. The information provided in this training does not supersede policy and procedure. Any changes to the policy and procedures may make this training material obsolete. Use this training material, check to assure it is still relevant. Okay, so here are some resources, the RMA website, of course, and then our NAU website for any whole farm resources. Here are some acronyms that may be helpful if you need to come back to this and reference. I think Clasey has already sent out a PDF version of this, so you all should be able to go back and look through. Here is the whole farm insurance cycle after sales closing date. So as you see, it's got sales closing date, acreage reporting date, production reporting date, and how it kind of compares to the MPCI policy. So the intended acreage report is the same thing for whole farm as the intended farm operation report. Same with acreage report and revised farm operation report and the production report and the final farm operation report. And that's just kind of the order it goes in and repeats. So some important dates, sales closing, cancellation, and termination dates for calendar year and early fiscal year filers for whole farm. There's January 31st, February 28th, or March 15th, and this all differs by county. For micro farm, there's February 28th, March 31st, or April 15th, and this also differs by county. For late fiscal filers, their date is November 20th. Revised farm operation report date is July 15th for everyone. Contract change date is August 31st. And late fiscal year tax filers, the tax year begins on September 1st or later. And so here are some, like a basic summary sheet kind of explaining everything. So availability, WFRP and micro farm plans are available in all counties in all 50 states. The liability limit for whole farm is 17 million insured revenue, and for micro farm it is 350,000 approved revenue limit for the first year, and then 400,000 for carryover insureds. The coverage levels are 50 to 85%, and that's all in 5% increments. Coverage protects a farm operation against the loss of farm revenue, earned revenue, or expected to be earned from commodities produced during the insurance period, whether they are sold or not. Commodities bought for resale during this insurance period, all commodities on the farm except timber, forest, and other forest products, and animals for sport, show, or pets. There is no payment rate. The animal or animal product limit, its expected revenue is up to $2 million soft cap, and that excludes aquaculture. And then nursery and greenhouse also has that $2 million soft cap. One commodity, there are no restrictions unless one commodity using commodity count, and that commodity MPCI revenue protection plan is available, or one commodity is potatoes. So I don't think that'll be an issue in your area. Other federal crop insurance underlying policies for WFRP, the underlying MPCI is optional the insured can opt out of the underlying coverage, becoming the primary insurance. For microfarm, MPCI coverage is optional and the underlying MPCI coverage is not considered the primary insurance. Cause of loss, WFRP and microfarm provides protection against the loss of insured revenue due to an unavoidable natural cause of loss, which during the insurance period, and will also provide carryover loss coverage if you are insured the following year. Then you can see the policy list for a list of covered causes of loss. Expanding operations. For WFRP, the simple average allowable historic revenue increased by up to 35% if the operation physically expanded or the insured increases use of existing production and if approved by AIP. This allows for farm growth in the lag year or policy year that may or may not trigger indexing. Expansions due solely to certified organic expansions is greater of 35% or 500,000. For microfarm, only the addition of production capacity during the insurance period may be considered. And then again, the contract change date is August 31st. And then here are the sales closing and cancellation dates that we already went over. Replant payments for WFRP are up to 20% of expected revenue times coverage level for annual commodity with 20 acres or 20% of crop needing replant. It is not applicable if also insured under MPCI with replant provisions. Payment takes into account share, not applicable to microfarm. Subsidy factor. WFRP farms with 2 or more commodities will receive a whole farm subsidy factor if the minimum diversification requirements are met. Farms with 1 qualifying commodity will receive the enterprise unit level of subsidy factor. Microfarm automatically qualifies for the whole farm subsidy factor for 2 or more qualifying commodities. Revised farm operation report. All revised farm operation reports are due on July 15th. So I know that is a lot, but you can always come back to this and yeah, it just gives a basic overview of what's going on with these policies. Okay, so the WFRP is highly subsidized, and here's just kind of a chart that explains that. So premium discounts also apply. Commodity diversification. The commodity count is a measure of the diversification of a farming operation. Feature of WFRP is that premium is discounted as the commodity count increases. The maximum diversification discount is realized at a commodity count of 7 commodities. The commodity count is also used in determining eligibility, as a commodity count of 1 may restrict eligibility for WFRP. So the higher the commodity count on the farm, the more the farm qualifies for premium rate discount called a diversification discount. As you can see here, there's 3 commodities and it's shown there. And here are the diversification factors. It kind of shows that even if you do have like 4 commodities on the policy, if it doesn't meet the requirements of this formula, then it may be dropped down to 2 or 1, just depending on how much revenue they're bringing in. And this kind of just details that. So, in addition to the subsidy and diversification, other premium discounts apply. Purchasing underlying MPCI at buy-up coverage levels, and VFR and BFR are just 2 examples of this. And WFRP basics other insurance for individual commodities. Nothing prevents an insured from obtaining other insurance not authorized under the Act. They can also have NAP and private products insurance. Okay, and so for WFRP and disaster program payments, um, basically what this is saying is these do not count against the insured during claim time. Okay, so WFRP basics with the coverage, a whole farm insurance product that provides producers with risk management protection for all commodities on the farm under one insurance policy. And then the commodity list for each county in the actual actuarial documents. So here's an example here where it shows everything that is available. Okay, so to continue on, this provides protection against loss of revenue due to unavoidable natural disasters during the insurance period that a producer expects to earn or will obtain from commodities produced or purchased for resale during the insurance period. The approved revenue amount is the lower of the total expected revenue on the farm operation or the allowable whole farm historic average revenue. And again, the coverage level ranges from 50 to 85%, and CAT coverage is not available. Okay, so qualifying persons criteria and insurance eligibility. To be considered a qualifying person, the entity must be eligible to receive federal benefits, be a U.S. citizen or resident, file a Schedule F tax form or other farm tax forms that can be converted to a substitute Schedule F. And for those, remember to check the entity and tax forms match. That's something that we have been running into. The Schedule F or substitute Schedule F must cover 100% of the farm operation. It needs to be engaged in the business of farming and derive revenue from the production of commodities and derive not more than 50% of expected revenue from commodities purchased for resale. And then the company must verify applicant is qualified to be insured under WFRP before accepting the application. Okay, so to continue on, the tax entity and WFRP entities must match. This is the main thing to take away from this slide, that those two need to match. And then WFRP livestock and nursery limits. Both of these have a $2 million soft cap. In this, the soft cap allows whole farm to provide up $2 million in coverage for any size livestock or nursery operation without excluding operations. All revenue earned from the sale of livestock nursery and greenhouse commodities is revenue to count. And that is all I have. Do you all have any questions?
I have a couple of questions, Tanner. I don't know if you can stop sharing and then
Okay.
that way we could see each other better.
Mhm.
Okay, so one question I have is for the whole farm insurance, for someone to get a policy, do they need to have they need to have a historic average revenue record or Schedule F paperwork? And how many years of that information do they need? Historical information do they need to be able to apply?
Lacey, do you want to answer that? Or
That's fine. So for 2025, keep in mind that that sales closing date has already passed. For most growers in North Carolina, if you go a little bit further north, there's a 3/15 sales close date that they'll hit. But so basically for 25, you're going to look at the year prior as the lag year. So they'll need to have farming records there. But most of those guys haven't had an opportunity to file their taxes yet. So then we're going to be looking at the 5 years prior to that. So we're going to be looking at 23, 22, 21, 20, and 2019. So your historic period is going to be 2019 through 2023. So they're going to need to have Schedule Fs For those years, if they don't have the Schedule Fs, then you're looking at farm tax forms that can be converted into a substitute Schedule F. So, I mean, those guys are going to be filing taxes, and those might be under a 1040, a 1065, or an 1120, depending on how their entity is structured. So if it's, an individual or a married couple, you're going to be looking at a 1040, and then some of the corporations or partnerships, you're looking at 1065s, 1120s, depending on how they file. So those are all equivalent, I guess, if you will, for insurance purposes.
Okay, so for a beginning grower to
Mhm.
know that they need to keep those records, and it looks like about 4 years in of records going into the 5th year, they could look at a policy. Is that
Yes,
fair
and
to
if
say?
they do qualify as what's considered a beginning farmer rancher or a veteran farmer rancher, traditional multi-peril, has got 5 years that they're able to qualify for that. Whole farm extends that out to 10 years. So you can qualify with as little as, I think, 3 years for whole farm. And so if they've got, 24, 23, 22, and then 21, 3 years plus their lag year, they'll be able to qualify there. So you're going to have the 4 years of taxes to be able to qualify as a new grower. And
Okay.
so you've got to be a little bit careful there. If you have a lady that's married to a farmer that maybe she was married to a farmer before, and then if he's got more records, because she was considered part of that farming operation, we have saw where that has knocked people out. So just kind of keep that little tidbit in the back of your mind there. But if they've been together and, they've been farming for, a few years, they might be able to qualify for the whole farm. And so we'll be happy to look at any specifics. If you have a specific scenario and you say, hey, I want to run this by you, would these guys qualify? We'll be more than happy to take a look at that.
That's super helpful. Thanks, Claycy. One other question. So the difference between whole farm and micro farm, other than the sign up dates, would it be the amount of coverage? So like you can get a lot more like higher revenue coverage for a whole farm, but for the micro farm, it looked like it was 350,000 to
Yes.
400,000. Is that the main difference here?
That is, there's a little bit of a rating difference is what we're hearing as well. But for those smaller growers, if they're bringing in less than the 350,000, then they can qualify for microfarms. And so it's a little less of the paperwork. So if they're doing sales out of the bed of their truck, or they have a farm stand, or they're doing farmers markets, it's a lot easier for those guys to look at kind of a conglomerate, all of their all of their commodities that are being sold are kind of lumped together. And so we're looking at total acreage, total revenue for those guys. Whereas whole farm, we want to see, okay, we need all of your watermelon records and all of your cucumber records and all of your persimmon records and all of your blackberry records and all of your gooseberry, and we're splitting those out by those individual commodities on whole farm. But micro, if they've got, if they're selling 3 quarts of blackberries at the farmer's market and they're selling 10 quarts of gooseberries, and it's like, golly, how would they ever break that out? Micro is a shining star program for those folks.
That is very helpful. Thank you. I think there's a
Sure.
lot of confusion sometimes about what would be better for which operation. So
Sure.
those are the questions I have. Rachel, Luke, do you guys have any questions?
I just have one question. So you mentioned specifically the exemptions for like forest products and then nursery and greenhouse. Those are kind of under a different cap in terms of what you can count towards whole farm and micro farm. But it sounds like for the most part, it doesn't really matter what the commodity is, or do we look at that county by county report that you mentioned in terms of what specific commodities can count towards this policy?
So let me clarify a couple things from the beginning. So forestry and timber products are not insurable under whole farm, period, or micro. So we're not looking at that. But if we are looking at individual nursery products, so if you're growing, I don't know what, apple trees that you're selling the trees to the orchards or something like that, or if you were selling begonias or whatever the nursery products are, like those are going to be limited to $2 million. And then the animal products are going to be limited to the $2 million. So if you've got cattle, you're going to be limited to that $2 million. And then aquaculture is exempt from that, so they can go above the 2 million for aquaculture, but that can get a little tricky. So when you're looking at yields and values and stuff, but hopefully they should have the records. And again, if you've got a specific operation in mind, we can look into those specifics.
Cool. Thank you.
Sure thing.
Rachel, did you have a question?
No, I think you all answered or asked the same questions I had. So.
So can we share, so we're gonna have this information available. Can we share your contact information? Should we share the information for Ag South, or like who should we send growers to talk about these policies?
Yeah, I'll let Brandy take over there.
Yeah, that's fine. You can share my information or Carrie Garrett's information, and either one of us can get in touch with the NAU team if we can't answer the questions.
Thanks, Brandy. That's what we need. So we will get that to the producers. I think that's it for questions. Great job. We appreciate you. Thanks so much for giving us this information and letting us record it and share it with our growers.
Thank you for giving us the opportunity.